Hi, everybody. I think we're going to get started now. Welcome. I'm Nancy Hancock. I'm a lawyer at Pullman and Cumley, and I'm here to welcome you to today's Tech Talk. Our topic today is navigating the federal and state research and development tax credits. Our panel today will be Bill Claffey and Alan Hurwitz. And I'm going to do a couple of housekeeping items before we start. The first is there are Q&A, places where you can script your own questions, and they will or may be answered by our two panelists. And also, we are recording this session, and the recording and the slides will both be available probably within 24 hours after this. We will email links to everyone who registers. First, let me introduce Bill Claffey. This able presenter is a partner at Fiondella, Milone and LaSaracina LLP, FML LLP, a full-service accounting and tax firm headquartered in Glastonbury. Bill specializes in federal and state tax credits and incentives, including the federal and state research and development tax credit, which is convenient for us today. He has helped FML's clients claim over $40 million in tax credits and incentives since 2010. In addition to leading these incentives and the tax credits practice at FML, Bill also leads the firm's state and local tax practice section. He consults on tax and local income tax matters, including nexus, filing, tax liabilities, planning, sales and use tax, voluntary disclosure assistance, and other items, including local property taxes. Bill also has played a critical role in FML's M&A practice, providing tax due diligence on potential acquisition targets and sell-side diligence. Bill also, if he's not busy enough, has been leading FML's COVID-19 tax force, along with Frank Milone, who is a Connecticut CTC board member. Bill is a graduate of Providence College and Quinnipiac University School of Law, and he's a member of the Connecticut Bar Association, as well as CTCPA. Our other panelist will be Alan Hurwitz. He is the CFO of Continuity, which provides regulatory technology, which is RegTech for those in the know, solutions that automate compliance and risk management for financial institutions. Alan has 25 plus years of experience managing the financial affairs of mid-market and growth stage companies. Alan's focus is on increasing enterprise value, improving sustainability, and enabling team success. His accomplishments include turnarounds, aligning operations with value props, raising capital, and developing strong financial and risk management systems to support growth. A little of Alan's history is he was an audit manager at PwC, and he managed a worldwide internal audit and spun off a company out of Duracell. He also has led SaaS businesses in healthcare, compliance management, and marketing automation. He's a graduate of the Eisenberg School of Management at UMass. Alan is also a CPA and co-founder of the CFO Knowledge Network. Welcome, Bill and Alan. Please teach us.
Thanks, Nancy.
Thank you very much, Nancy. And I want to really thank Alan for joining me somewhat on late notice. We had put this together a few weeks ago, but we really thought it would be helpful for the audience to hear a client testimonial. And I've worked with Alan on a few different occasions, and one, really enjoyed working with him. And I thought between the work that we were able to perform with regard to this credit and some of the other work, but especially with the R&D credit, was able to generate some nice value for your companies, Alan. And so I really appreciate you joining me here today on this panel.
Happy to be here.
Okay, I am going to try and share my screen. I think this is the right time, Nancy, to share my screen and put the presentation up. Is that showing on the screen, Alan? Do you see that?
We can see it.
Okay.
Looks good.
Okay, everything's good. Okay, great. Nancy, thank you for the introduction. I wear a lot of hats at our firm, but certainly driving our tax credit practice, which is predominantly the research and development tax credit is one of those hats and one that I wear proudly. It drives a lot of value to a lot of companies all across the country, but especially here in Connecticut. We do a lot of work with all different industry types. It's not industry agnostic, but there are certainly a lot of industries that folks may not think of in terms of R&D. I mean, of course, you've got your biotech companies that certainly qualify, but a lot of manufacturing, software development is certainly a very key industry where credits are available. Manufacturing, as I mentioned, in certain service businesses can also be eligible for the credit. And so some of those businesses are often overlooked. And there's very valuable dollars here that they can utilize as tax credits, or as we'll see in the presentation, even if you're not operating in a tax income position and have a tax liability, you can turn those credits into immediate cash, which is especially for new growth stage and newer businesses can be critical to your success and your ability to invest back into the company. So let me see here. Okay, talking points. So today I'd like to cover, I've got about 25 minutes, but I'd like to do an overview of the federal R&D tax credit. We'll go through an overview of the Connecticut R&D tax credit. How are they the same? How are they different? How can you drive those values today or in the future? We're going to talk about monetizing the Connecticut credit. That's always the big nut. Connecticut has probably the best research and development tax program of any state in the country. And we'll get into why that is. There's multiple reasons. And I think it's kind of the genesis of what created this presentation. I wrote an article that I think was picked up eventually by the Mirror, Connecticut Mirror, and then made its way around social media with regard to Connecticut's credit. How do we make it better? How is it great, but how do we make it better and how do we sustain it? We'll talk a little bit about some of the other COVID-related tax credits that are out there and some of the other programs that are out there, but more, we'll go into them briefly, but more in terms of how they relate to the R&D credit, because there's some special things that you need to understand with regard to those programs if you took advantage of them, and then what happens with your R&D credit. Okay, so we'll start at the top here, the federal R&D credit. So this is a credit that goes against your income tax liability. It's eligible for all taxpayers. It's housed in Section 41 if you care to take a read through it. If you're operating your business as a C Corp, and I know a lot of companies that may be coming up through CI or through other agencies, they may be a preferred C Corp. They may prefer a C Corp structure, but you may have many pass-through entities, S Corps, LLCs, partnerships that are doing the same type of activities. They are also allowed a federal R&D tax credit. It's just the manner in which that credit gets, how it gets allocated at the C Corp level. Obviously, the corporation will take the credit against its corporate income tax. If you are a pass-through entity, that credit will pass through the membership structure. So that credit could go directly to an individual owner, or it may pass the chain through multiple pass-through entities eventually to some sort of tax-paying entity or individual. This is going to become very critical because we'll see when we get into Connecticut, the credit is only available for C corporations. But just understand that just because that's the Connecticut statute, federally, regardless of your business structure, you may be eligible for an R&D credit. Okay, generally, big picture, we've got, this is real big picture. You're going to be looking at, how do I calculate the credit? What's my ROI, right? That's always the question we always get initially as we talk to a client. Is it worth it? Is it worth it for me to try and calculate this credit? Is it worth for me to try and spend the time to substantiate this credit? In most R&D credits, Connecticut's a little bit different, but it still kind of has this base amount calculation. They're typically considered incremental R&D credits, meaning you have to get over a certain base amount to a base amount of spend to be able to take credit on dollars that you're spending on R&D. And so from a federal perspective, there's two ways to calculate that. One is the standard method, and they give you a little bit of a higher rate on the credit. And the second method is the simplified method. The simplified method has been in place for about 10 years, and it has a lower credit base, and we'll talk about each method. But the key is that you establish a base amount under each method, and then you only get credit on the dollars that you spend over that dollar base amount.
And Bill, I think in my experience as a client here, I think you came in very quickly and were able to get a quick read on whether it was going to be worth going through the exercise, right?
Yeah, we try to, as we go out to our clients, we want to try and quickly get some sort of an understanding of what was your spend in the prior years, what's your spend baseline in the current years. We'll take a look. What did you spend on wages? What did you spend on other categories? We're going to go through here, Alan. But yeah, I mean, you want to get that early sense of, hey, is this something that that may be worth it for us? Because it can be an involved exercise, and everyone's busy, right? Everyone's going in a million different directions. So to spend some time on this, you want to have an understanding of what your potential benefit is. So just quickly, and there's a lot of details here, but I'll try and get through it quickly. The standard method requires you to calculate a ratio, and that ratio is research expenses over gross receipts. Depending on when your business started, that the years in which you're looking at that ratio shifts. So if you've been in the federal R&D credit was enacted, I believe, in 1981, right in the beginning of the Reagan administration. If your business was around during that time, then your period, it's called the fixed base percentage, that period that you have to calculate research expenses over gross receipts is 1984 to 1988. If you haven't ever done it, you probably are going to have a hard time calculating that. If you are a startup company, then there's specific startup rules that apply. And depending on when you started up, your first 5 years will have a fixed base percentage of 3%. Then you'd be looking at in years 6 through 10, you're looking at a different mix of years, and your same calculation though, qualified research expenses over gross receipts, and that's all driving toward this thing called a fixed base percentage. You take that fixed base percentage, you multiply that by the average of your prior 4 years of gross receipts, and that becomes your base amount. And that establishes your base for the standard method. All right. So let's say that base amount is $100,000, and in the current year you spent $175,000 on R&D. You're going to get credit on 20% of $75,000. If you went through that calculation and your base amount was $25,000, but you spent $175,000 in the current year, the standard method has a cap, and that the cap is capped at 50% of your current year research expenses. So you don't get to take credit on 150,000. You get to take credit on 50% of 175,000. That's kind of the old way of doing it. It's still available as an option. As Alan mentioned, one of the things we go in is we say, okay, let's try and figure out what our standard method is, because you do get a 6% jump on the credit base, on the credit percentage. Then we look at the simplified method. The simplified method is just looking at your research expenses in the last 3 years, coming up with an average. If you've already filed those returns, it's a very easy exercise, obviously. If you file the returns with the R&D credit. If you haven't, it requires us to go back, and Alan, we may have had to do this with one of your companies, to go back and say, all right, let's try and understand what your R&D expenses were for the prior 3 years. If we're only going to calculate the current year, we have to have at least some sort of a working knowledge on those prior 3 years. It doesn't necessarily have to be as kind of tied to as we're going to get on your current year, but we have to have at least a working knowledge, because we're going to take that average of the prior 3 years, we're going to cut that in half, and then that becomes our base amount, right? So in a kind of a simple example, I've got $175,000 in my current year of qualified research expenses. And in the prior 3 years, I work with Alan and I say, let's try and understand what your numbers were. each of the one year was last year was 150, the year before that was 100, and the year before that was 50, right? They're in growth mode. Well, that average is 100, right? So I get to take half of that. Half of 100 is 50, and my current year is 175. I get to take a 14% credit on 125. There's no cap. The 50% cap that we talked about under the standard method does not exist. And these slides will have, I'll have a more detailed slide on how these two methods work. But the important thing is Alan mentioned, is that let's get an understanding right from the get-go. What do we have? How far back do we need to go? Can we get information that we can even calculate the standard method? And then does that information help us to get more credit, or should we just rely on the prior 3 years, the simplified method in the prior 3 years?
Right, and the tools I think that we use, Bill, that you had some kind of worksheet that we were able to use to do that, to look back 3 years. It wasn't, I mean, I definitely needed your help, but it was not terribly difficult to go through that exercise. It was pretty easy.
Yeah, we'll get into some of the definitions. So this will hopefully make sense for people as we're going through that. But yeah, once we can identify it, and it depends on the type of the industry, the type of company. Some companies have very centralized R&D functions. Some it's more scattered. Some may have a lot of R&D folks in a manufacturing sector, which makes it a little bit more challenging. And some may be startup biotech companies where it's very easy to understand who's doing the R&D. It's everybody other than folks that are in accounting and finance and things like that, HR. So let's take a look at R&D expenses. Big picture, this is again going to the federal credit. It's wages, supplies, and 65% of your consulting fees. Everything else that you spend on R&D is generally not eligible for the federal credit. So I get this question all the time. Hey, we just bought a big piece of equipment that we're going to use for R&D. Can we include that? It was a $2 million spend. The answer is no, on a federal perspective. Now, the next question might be, you spent $2 million on a big piece of equipment, but all that equipment had to be customized for your own usage, had to be customized for various testing that you were doing. Well, now we're getting into, okay, well, were there individuals that may have been working on that equipment that may have been doing qualified activities, and we're going to talk about it. Now we're looking at potentially qualified expense because that's in the wage base. Supplies, typically defined as tangible property that's used and consumed in research. So typically, if we're looking at manufacturing or we're looking at biotech, those supplies are pretty identifiable. You'll see them as prototypes, pilots. We'll kind of look through those accounts within the trial balance or those different types of details, and we can find that. In some other industries, it's a little bit more challenging to try and get your hands on supplies. Usually, like in the computer, like Alan, for your company, for computer software, right? I don't know if we ever took any supplies because there's just not any tangible consumable supplies that you're going to be utilizing in a software type industry. Right, that's right. Now on a consulting side though, so then we're looking at consulting and wages we would look at, but on a consulting side, this is especially in the software world, we will a lot of times, especially in today's world, a lot of that coding and software development and architecture may be outsourced. So to the extent that it is, and you are using outside developers to do some of that work, that cost is includable as long as it's qualified, but it's includable at 65% of whatever your spend is. So Alan, I can't recall. I don't know if I think you guys may have had some outside developers, but I can't recall if that was a big piece of our credit when we worked back a few years ago.
I don't think it was. There was a piece of it, but it wasn't a big piece of it. It was mostly in-house. Yeah,
it was mostly in-house. So it just depends on how the organization gets structured, but just be aware some outside spending can be included. Wages, it's qualified wages. Look to box 5 on the W-2. That's always our starting point. And then the next bullet here, self-employed. So this becomes an issue, or becomes an issue and a potentially very profitable issue for the company in terms of qualified R&D credits. The definition of wages includes of partners and shareholders, owner employee type shareholders. And so the question becomes, well, how much of that can I include? Because what happens, especially in a partnership structure, is you've got guaranteed payments, and that's typically paid for services, but there may be a large distribution or ordinary income that's flowing through the individual. And so, and that individual typically wears a lot of hats because they are a partner or a member of the organization. So the IRS allows you to take that compensation as long as it's reasonable. So we've gone through with our pass-through companies with the owner. Okay, how much time are they spending on R&D? Sometimes they're more pure management role, and so that time is very little. Sometimes they're very involved in the business. So we'll have to look through that self-employment income, come up with an allocation, and then make sure that compensation is reasonable, because it may swing very wildly from year to year. But just keep in mind that you may have expenses that are beyond your W-2 employees. Okay, supplies, we just talked about. Tangible property other than land improvements, depreciable property. Contractors, we talked. Okay, so this was going back to that the example of the consultants. They have to, one of the exclusions is that the work can any services performed off of U.S. soil is not includable in the credit. And so in the software world, especially in the last few years, what I found is that there's been a very heavy use of outside developers for certain software architecture type projects. And many times those software developers are located in Europe, potentially in India, and other areas of the world. But that's where I see most, actually Eastern Europe to be specific. I see a lot of developer activity. And so even though that activity may benefit the US based business and go into a product that's going to be managed and controlled in the US, the fact that they're overseas doing the work means that it's just disqualified right from the get-go. So as you're kind of looking at your big picture, you're saying, well, we spent a lot on R&D, but if it's for software, if it's for some other things, and it's a lot of it is overseas, it may not qualify. Okay. We talked about the standard method. We talked about the simplified method. So once you get into that calculation, right, you're going to end up with a tax credit that's going to be a dollar for dollar tax credit against your taxes. There is a they call it a 280C election. So basically, the IRS is not going to allow you to take a tax credit and a deduction for the same pool or the same general expenses. So you have one of two options. You can either add the tax credit back to your deductions. So let's say you had $100,000 tax credit that was based off $1 million of spend, somewhere in that range. You don't add back the $1 million of spend, but you have to add the tax credit back to your income. Or you can take this 280C election, which basically, and if you're in a partnership or in a pass-through business, it's better for you to make this election in that structure, because what it does, it says, I'm not going to add it back to income. I'm going to make the 280C election, and I'm going to take a reduced credit, and the reduced credit is based off the corporate tax rate, which in our current taxes is at 21%. So we always advise our clients to make sure they take that election. The carry forward period for R&D, the federal R&D credit, is 20 years. So again, question comes up, we're in losses, or you get introduced to a company and they're like, well, we never considered it. We have a lot of R&D going on, but we never considered it because we've been in NOLs for a few years and we're anticipating losses for the next couple of years. Well, that's fine, but you may not have immediate use for it, but just keep in mind that there is a 20-year carry forward period, and you may have full use of that in 5 years, 3 years, however long it takes you to burn through your net operating losses. This becomes really critical especially in the biotech sector, where they're generating significant losses in years 1 through 7 as they're trying to get their product to FDA approval. But once they do, they start to churn through and burn through NOLs pretty quickly, and those credits become very valuable. One thing to be aware of is this payroll tax credit election. So if you are a qualified small business, and there may be firms or companies on this presentation that would meet this definition, you may have losses. You may have and you may not be anticipating income for for 10 years. Or you may always come from a tax perspective. This is a tax perspective, not a book perspective. You may always kind of be break even. If you are a qualified small business. And so what does that mean? It means that you have less than $5 million of gross receipts in your current year, and you can't have had any gross receipts prior to 5 years from the end of your current year, right? So if we're looking at 2021, you can't have gross receipts of more than $5 million in 2021, and you can't have had gross receipts in 20, 19, 18, 17, 16. If you had gross receipts, I'm sorry, 15. If you had gross receipts prior to that period, then you would be disqualified as qualified small business. You wouldn't be able to make this payroll tax election, which is if you make the payroll tax election, you're basically saying, I'm going to take my R&D credit, and instead of applying it to my corporate income tax or my pass-through tax to the individuals, I want to apply it to my payroll taxes, and I want to apply it to the employer piece of my Social Security tax. This becomes a viable option for companies that aren't going to get utilization of the credit for multiple years, and they're fairly confident of that. They are going to bite into that credit 1 quarter at a time through their 941 in offsetting their payroll taxes. So the analysis you'd have to go through is what is my projected income? What do I have as projected losses? And what's my payroll? Your payroll, your payroll tax that you can apply to is about 6.2% of your payroll. So figure that's your annual employer piece of your payroll taxes. Under which mechanism can you burn through the credit faster? One comment on this payroll credit election is the definition of gross receipts. Still a little bit undetermined, but this question comes up all the time as well. We don't have any sales yet. We've been in business for 5 years. We've been in business for 6 years, Bill. We don't have any sales yet. Do we have gross receipts 6 years ago? And so the IRS they haven't really forwarded the argument yet. But there was a lot of opposition to the way that the way that they define gross receipts, which goes through this kind of myriad within the internal revenue code, to include almost anything, which includes interest on bank accounts. It includes potential grant money, right? And so I know a lot of companies that may be in this presentation through the technology council. You may have grants. You may have set up a bank account 6 years ago. If you did, at least currently, and you had interest income or you had grants, you may be ineligible for the payroll election, which is unfortunate because I don't think that was ever the intention of the statute. So that's the payroll credit election. It's run through. So there's an election on your income tax return, and then there's a form that you would file with your 941. So every quarter, your business is filing a form 941. Probably every other week, you're making payroll tax deposits. So at the end of the quarter, you reconcile it with the 941. That's where the credit goes, and you would get a refund for whatever payroll taxes you can offset. Okay, so let's get into kind of the $1 million question. Well, what is qualified research, right? That's great. We've got this calculation. We've got some other elections we can make, but how do I know whether what I'm doing is qualified research? There's basically a 4-part test, and we're gonna go through this rather quickly. But there's the discovery test, which is also known as the Section 174 test. There is a technological in nature test. There's a business component test, and then there's a process of experimentation test. So if we take them one by one, the discovery test basically means, is there uncertainty? Are you trying to discover information that would eliminate uncertainty in the development of a product or process? And that's a lot of words, and there's a lot of subjectivity to that, but it is what it is. That's the way that it's written in the code, and that's the way you'll see most case law write it up in their opinions. In terms of, well, how do I know whether uncertainty exists? They use this public information available test, right? Uncertainty exists if the information available to the taxpayer does not establish the capability or method for developing or improving their product or process, or the appropriate design of their product or process. And again, that's the language that's in the regulations. So if your competitor is doing something, but it is not publicly available information, and you have uncertainty and you are a qualified professional in that industry, there is a strong argument that you would meet the Section 174 uncertainty test. There's no requirement that to meet this test, you have to establish and receive a patent. It helps, but it's certainly not a requirement. The technological in nature test, whatever you're doing has to be in an identified hard science. So that's physical, biological, engineering, or computer science. So if you're doing something in those areas and you're trying to eliminate uncertainty as it relates to a product or process, then you've fulfilled the technological in nature test. Business component test, it's got to be related to a new or improved business component, which they identify as any product, process, formula, design, or pilot. So anything so really, if you're trying to improve, enhance the reliability, quality, performance of any of your products or processes, and I want to make sure that we don't exclude process. You could be developing a process within your business that you're selling. You could be developing a process within your manufacturing process to develop product. That can all be qualified. And then lastly, there's a process of experimentation test, meaning that are you going through an iterative trial and error process to try and eliminate the uncertainty that you've identified in part one.
And Bill, I think that's a lot to digest. I don't want people to be scared off by that.
Yep.
In our case, when you came and helped me at the marketing automation company, this was, we navigated this beautifully because we weren't curing cancer and we weren't inventing clear aluminum. We were doing something new around the way we were working within that field of marketing automation, and it applied. It still worked. It didn't have to be something patentable, like you said. And so I don't want people to be discouraged by that, because there are these tests and you do have to meet them, but chances are, if there's a way to find it, you'll find the way to get there, Bill, right? So, It's good to ask the question.
Yeah, I mean, that's what's, that's the way it's listed in Section 41. But anyone can do a Google search on this call and look up R&D tax credit. There's multiple firms. I mean, we do the work here. We're a full service firm. There's firms that only do R&D tax credits, and we do a lot of work in that area too. But this is much broader than Pfizer. It's much broader than Moderna. It's much broader than UTC. Of course, those companies take great advantage of it. But like you mentioned, Alan, there's a lot to be picked up, and you can look at those definitions that I just went through, and the reason it gets the R&D credit gets it has a lot either written about it or it's discussed a lot, is that that test is very subjective, and you can make strong arguments with a lot of different industries, kind of pro and con. So there's inherent in there. There is some risk, but if you can defend it and vet your information and understand, hey, this was the uncertainty, here's how we faced it, and here's how we went through the process. A lot of industries can qualify for this. So quickly, excluded activities, they're here. These are things that are listed. We talked about foreign. I want to quickly talk about funded research, which is the last bullet. There is an exclusion in the statute that says if research is funded by a third party, then it's not eligible. The costs are not eligible for the credit. Funded research has a very specific definition, in that it has a specific definition, and there are definitions of what funded research is not. So a lot of times we'll meet with somebody and they'll say, well, I was paid to do this project, right? Whether it be either a software development project or an engineering project or what have you. But if you took on the risk as the taxpayer in doing that research, and you own the underlying technology that kind of resulted from it, then that's not considered funded. And so as you go through the litany of like case law, they basically get down to, well, if you have a fixed fee type project and you own the underlying research, then we're not going to consider that funded. If it's a pure time and materials where you're not at risk, or you never own the technology, then they're going to consider that funded. So understanding that dynamic, we see a lot of companies especially it seems like recently the model has gone toward more fixed fee pricing. We see that often in some of the even in some of the government contracts where it may be fixed fee. If we can point to, hey, this is one, it's a fixed fee project. Two, there's milestones that you were contractually required to meet before you got paid. You're taking on the burden and the risk. And therefore, as long as the technology is yours, then you may be eligible. Those costs would still be eligible for the credit.
Hey, Bill, I have a question.
Sure. Can
the funder take the credit if they have a sponsored research agreement?
It's one party or the other. Now, I can tell you, I don't know if the two parties are in sync in terms of their tax return process, but conceptually, it's supposed to be one party getting the credit.
Thank you.
On those specific funds. Now, they may have credits that they're taking for a similar project, but different expenses. Okay, wrapping up the federal. I'm not going to do the sample calcs. Their recent update, a tax council memo came out about a week and a half ago from the IRS, where they're going through refund claims and they're trying to establish more precise ways of documentation that they're going to be requesting. So more information is going to come out on that, but there could be tighter documentation requirements. There is a provision in Section 41 that says that you're required to substantiate your credit. As Alan mentioned, we understood the projects, and I would work with some of his software engineers. We'd get some information together, and that was the substantiation package that we would put together. There may be some changes from the IRS on what's required and what's not required, and so just be aware that there's a new memo out there, and there may be some new requirements. I'm going along, which I told you, Nancy, I would. So I'm going to run over the Connecticut Credit. This is Connecticut-based businesses. If you're not taking the Connecticut R&D credit and you're doing R&D of any type, you're missing out on a big opportunity, especially if you're in a loss. So the Connecticut Credit is calculations a little different, and what's included in the Connecticut Credit is a little different, both to the taxpayer's advantage. Just gotta move my bar here. It all comes through 12-217. Connecticut has, instead of having one credit, Connecticut has got two. They've got an incremental credit and they've got a non-incremental credit, and we'll get into those. But, and this is important, it's the Connecticut R&D credit is only available if you're operating your business as a C Corp. So you could be on this side of the street doing the exact same activity as this company on the other side of the street, and you're operating as a C Corp, you're accumulating, very valuable R&D credits that you can turn into cash. And this business on the other side of the street is doing very similar work, but they're operated as an S Corp. Well, there's just no credit available to that company. The credit rules in Connecticut were written to offset the Connecticut corporation business tax, which is applied to corporations and not S Corps and not partnerships and not LLCs. There has been a lot of talk from various lobbyist groups to try and, including myself, in terms of some of the work groups that I work with, to try and include pass-through entities in the potential to get the Connecticut credit, because the work is very similar, and now because Connecticut taxes pass-through entities. So I think there makes more sense, especially since the last couple of years where Connecticut's had the pass-through entity tax. Key differences. Okay, so we've got the 20% R&E credit, which is the research and experimentation credit. That's the incremental credit. And I have a couple bullet points here: startup, C conversion, short period years. So you're always comparing kind of prior year. In order to take this incremental credit, you're looking at prior year, you're looking at current year, and you're saying, what was my increase? Whatever your increase was, you get 20% on. Whatever your non-incremental piece was, you're getting a varied rate. But if you're a qualified small business, you're getting 6% on. And there's some other rules related to when you can take it. The incremental credit is extremely valuable in Connecticut. If you're a startup company and you didn't have any R&D in the prior year, well, guess what? Your base period is zero. So every dollar you spent is eligible for the credit in that whatever tax year that is. What if you did a conversion? We used to be a partnership. We were getting some funding. The funding partner wanted us to be a C Corp. So we converted to C Corp status as of let's call it, March 1st. Right. So now your base, even though you were in operations operating for multiple years as a partnership, your base is zero. And now you look at your spending from March 1st all the way to the end of the year, and that becomes subject to or eligible for the 20% R&D credit, assuming it's R&D spending. Now you're going to go into the next year and you're going to say, well, I'm going to compare this 12 months of activity after the conversion, but what am I going to compare it against? I'm going to compare it against my last income tax year, which was a 10-month period. So even if your rate of spend was the same, you're still going to have an increase. So those couple things are not all firms pick up on it. And definitely, some of the smaller firms don't. And even to be honest with you, some of the bigger firms haven't picked up on those concepts. And I've had multiple conversations with DRS on, is this the way, am I reading the statute correctly? Because that's the way I'm reading it. And I've gotten confirmation from them that is the way it's supposed to be interpreted. Let me see here. We talked about the 6%, so non-incremental 6%. R&D expenses versus R&E. So Connecticut identifies the non-incremental credit. They call that research and development, whereas the incremental credit they call research and experimentation. And each has a somewhat different definition, which makes the application in the form a little bit challenging. But the big difference is that the R&E, the 20% credit, does not have a provision in the Connecticut statute that links you back to this funding principle that we talked about for the federal credit. So even though some concepts bring you back to federal concepts, they do not reference the funding principle. Whereas in the definition, they specifically reference you back to the funding principle. So you could have a situation where you are getting government grants and those are considered funded because we're not at risk. It's not a fixed fee contract, what have you. And so from a federal perspective, you're excluding all that cost that you paid to your employees that was funded through the grant from your federal R&D calculation. But according to Connecticut law, the funding principle doesn't exist. So you can include that cost in your Connecticut incremental R&D calculation. So it's important to understand that there's some difference. The other key difference is in the types of costs. We talked about federal. Federal is wages, including partner compensation, supplies, and 65% of consulting fees. Everything's got to be on U.S. soil. Anything else is not allowed. Connecticut, it's any cost incurred in the state of Connecticut that's directly related to research and development. So obviously we've got wages, we've got supplies. You even if you're buying those supplies from outside the state, as long as you're bringing them into Connecticut and using them here, you've got supplies. Consulting fees, not 65%, you get 100% in Connecticut. But the consultants have to be working in the state, and that provides challenges, right? I mean, we're a small state. There's lots of good vendors everywhere. But this was clearly put in place to incentivize the use of contractors and consultants within the state are operating in the state of Connecticut. Now, if you use a consultant that's outside the state, but they're coming on site here in Connecticut, that's includable. If you're using an IP firm, patent costs are eligible in the Connecticut credit. If the patent firm's located in Stamford, that's in Connecticut, you can use them. If they're located in Port Jefferson, New York, then you're not able to use that cost in your qualified pool. Okay, so that's what I'm talking about here. So we're talking about broad inclusion, patent fees, right? So we're going. The credits both have a 15-year carry forward, and then we're going to get to kind of the big piece of it here coming up. I know I'm running late here. Is the how do I monetize this credit? This is, and Alan, I know we did this with your companies.
This is the best part. Yeah.
This is the best. I say the best part for last, right? The Connecticut R&D credit is refundable. And so what happens is especially companies that may have a little bit of a multi-state profile, meaning they've got some other reason to file in another state. They may pay very little to Connecticut in terms of state corporate business taxes, state corporate income taxes. or they may be in a loss and they may pay the capital tax, which we're thankfully getting rid of, hopefully sooner rather than later. It was set to sunset on the 2024. That's been pushed back, but we're trying to get that back to a 2024 sunset of that. But they may be in losses. And so now they're saying, well, this is great. I've got a whole bunch of credits. We went through the calculation. I had this big spike. I had the big increment. I got 20% R&D credit. But I'm never going to, I'm either never going to utilize this thing because I'm only paying small increments of income tax to Connecticut, or I'm going to be in losses and I may not use it for 10 years. Again, very important in the biotech, software, startup companies, they just don't have any use for it. Well, Connecticut's got an exchange program, basically a buyback program. And they allow you, if you are in a current year tax loss, to exchange your credit for 65 cents on the dollar. And you will literally get a check from the state treasurer's office for, if you had a credit of $100,000, you make the exchange, you're going to get a check from the state for $65,000. And Al, I think we did pretty well on that one, if I remember correctly.
It was phenomenal. I mean, look, just so everybody understands the impact of all of this. When I started at this company that we were talking about, and Bill came in to help sort of understand what we could do to minimize taxes, I was getting ready to write a $200,000 check, or $200,000 in checks to pay estimated taxes, federal and state. And we went through this analysis. I did not write that check, either of those checks. And instead I did get, it took a little while, but I got the money back. I did get a check back from the state. In fact, I think I ended up getting 2 checks back from the state over time. And we still had the federal credits and everything going forward. This ended up being $700,000, I think, in total of value that this company got, which was very meaningful and helped us really fund more development of what became our flagship product, because we got the cash in through this program from Connecticut and the credits against the state taxes, and it worked out beautifully. And it was, again, not tremendously difficult from my perspective. I know it's a lot of work, and you can see from the way Bill is explaining all of the nuances here that you have to know what you're doing. You know, everybody on this Zoom probably is probably hearing from these firms that do this specifically, and that's what they do. And again, they may be very good at it. All I can tell you is that Bill came in, he totally changed the whole paradigm for this software company that I was at the time, and has done great things at 2 other companies for me since then. So I know we're going to run out of time soon. I just wanted to make sure everybody understood that it does not require a ton of time. It is a bit of an effort, but getting through this process is very manageable. And thank you, Bill, for what you did for these companies.
Yeah, no, I really appreciate the kind words. I mean, what we did for one of Alan's companies that helped to build up this $700,000 is, and so this is like, you know, a lot of times the question I'll get is, can I go, okay, thanks for introducing this concept to me. Can I go back? And so, yes, you can, both federal and state, you can go back and claim R&D credits and claim refunds if you paid taxes in those years, or claim the credits and carry them forward as NOL carry forwards. And so that's often the case, right? You may have gone through, you got introduced to this concept, but you're like, gosh, I had a ton of development activity 2 years ago. We may have leveled off a little bit, but we really put a lot of time in 2019. So you can go back and claim those credits. Now, in terms of the cash option for this Connecticut exchange program, that's off the table. That has to be, and I want to be very, I want to really stress this. The 65% exchange program has to be filed on a timely filed return, or the state will outright just deny your refund request, your exchange request. Meaning you have to file your return on time or by the extended due date, and you have to have made your minimum payment on your extension. So if you extend your return on May 15th to file it in November, you got to make sure you make your full extension payment, because if you don't, The state will, they don't care if you did, something that was the most incredible research and development project that's ever been occurred in the state. They will outright deny your exchange request. Doesn't mean you don't get the credit, but it does mean that you won't get the 65 cents on the dollar in the form of a check. So that's the key way to monetize this in Connecticut. It's if you look at your profile, you can go get refunds for back years. That's one way to monetize it. The second is if you had taxes paid in those years. The second is definitely through this exchange program. And as long as you're in a loss, and that's critical, if you have $1 of taxable income in your current year, you're not going to have much tax, and you're going to have a credit, but you're also not going to be able to utilize it as part of the exchange program. Whereas if you had $1 of loss, you're still not going to have much tax, but now you can take that whole $100,000 credit or $200,000 credit. Personally, I've worked with a company here in Connecticut that 2 years ago we filed exchanges. In the aggregate, it was like $1 million to $1.2 million. So very significant dollars, and the program is very, very, very widely touted even by state officials because they know that it's helping to build certain sectors that Connecticut wants to build. The technology sector, right? The state has made an effort to invest back into technology, whether multiple different forms of technology and manufacturing for that matter. But they know that the dollars that are being refunded in the form of these tax credits and some of the other programs are creating jobs. They're creating new investments. They're creating new capital investments. So they're very pro, they're very pro this program. There are some requirements. You have to provide a narrative to the state saying this is what the research was, this is what the project was, here's how we quantified the cost, here's the people that were involved. Our narrative that we write to the state, typically maybe like 8 to 10 pages with some calculations behind it. And what the state will do is they'll do kind of like a rubber stamp type audit where they'll look through it. There's usually a number of people that are kind of devoted to that, and my firm, and I'm sure other firms have developed good relationships with those people. And then they'll authorize it, right? And then it goes to the treasurer's office, and you get your check. That process is supposed to take place in 90 days from the date you file it. This all goes through the tax filing, right? So when you file your CT 1120, it get the application, the credit documentation, the exchange, it all gets filed with the tax return. And there's no, while the credit has to be quote unquote approved or reviewed, it's not a competitive process. There are some other programs in some other states that they're good, but they require a pre-approval, and it may be a competitive process between you and another company. And then it comes down to, whose technology do they like better, who had the better relationship. This is a statutory program. And as long as your documentation supports what you did and how you calculated the credit, there's no they can't pick and choose who gets it and who doesn't. And then quickly, we got 5 minutes. Okay, so there's hopefully you folks are aware of a lot of the different programs available through COVID, through the COVID legislation. So you had the Family First Coronavirus Act, you had the Employee Retention Credit. Those were two biggies. More the Employee Retention Credit. If you had people that took medical or family leave, you were allowed a credit against of a certain amount against the amount that you were required under federal statute to pay those folks. And so you would get a credit against those dollars. And then the Employee Retention Credit, if you met certain criteria, you had a reduction in gross receipts, you had some sort of government order that caused a suspension to your business. There were very lucrative credits that were available to you from a federal perspective that were all refundable. And hopefully if you fit the fact pattern, you were able to take advantage of those. I mean, up to $7,000 per employee per quarter. So we're talking about some real money here. If you took advantage of those credits, just be aware that those dollars can't also fund an R&D credit, right? So if you took $10,000 of qualified wages for your Employee Retention Credit, you're gonna have to back that $10,000 out of your R&D credit calculation for 2020 and or 2021. So as you're thinking about this and you're saying, well, I know we do R&D, That's right. We did take the employee retention credit, and we took it for all 3 quarters in 2021. It might not be the best year for you because you're gonna have to reduce your R&D spend by that amount. So Nancy, I think that's kind of the end. I know we covered a lot there. And I really appreciate Alan for kind of bringing me back to reality here and making it real, making it real for people, because you get lost in the weeds sometimes.
I do have a couple of questions from our folks who are watching.
Yeah.
One of them is, what happens if you're paying your employees with stock options? Do you wait until they exercise? And in the year they exercise, you can apply that in your credit, or how does that work, or is it ignored?
So it's a good question. It does come up from time to time, especially for companies of all types of growth. But so you would look at, so the credit becomes the amounts that are subject to withholding, right? They get includable in the year that the option is exercised.
Okay.
And then you would look to the year in which the option was granted to understand whether the activity qualified, because those may be 5 years apart, right?
Easily.
Yeah, so you have to look to see, well, when was the grant and when was the exercise, and what is the direct link between them both. But the full amount is eligible for the credit as long as you can tie it to the qualified services during that time frame.
And does that work for all consulting fees? If I have to prepay, like I have I have to pay 50% up front to a consultant for a development activity, and then the money gets spent in tax year 1, and then in tax year 2, they're actually doing the services?
Yeah, so in that example, you would look to tax year 2, right? When even though you may have prepaid those expenses, you're looking to when the actually occurred. So you're going to have some adjustments here from your financials, and some M adjustments on the calculation, but it's based on when the services are provided.
And can you remind everybody again how far back they can look if they have, talking to you today is the first time they've heard of this credit?
Yeah. So it, from a federal and a state perspective, may differ. So, but the federal statute is 3 years from the date that you file. From the date that you file the return, the due date or the date that it's filed, right? So if you file a valid extension, so let's say your return is due April 15th and you file a valid extension, and that gets you out to October 15th, then you've got 3 years from that date, October 15th, to go back. If you file your return in March or whatever, or April, then it's kind of 3 years from that period. So if we're looking at, so today, right? If we're looking at today, you get introduced to the concept today, how far back can I go? Well, you probably filed your return. If you filed your, let me see, so we're looking at 2021. So we're looking at 20, 19, 18, 17. So 17 was filed in 18, right? So that 17 return is probably just outside the statute of limitations, because even if it was filed on extension, it was probably in the October timeframe.
Yeah.
So looking at the following year. From a state perspective, depends on the state. Most states follow the federal limitations, but there are some states, and we didn't mention some of these other state R&D calculations, which are good, not as good as the Connecticut one. They may have a 4-year statute. So it depends on the statute of limitations and the jurisdictions, but most are 3 years and some are 4.
Okay, we're at the top of the hour. So unless you or Alan has anything else to say, I'd like to remind everybody that this is recorded and there's a lot to absorb. So you should ask for slides and recording. And the second is that we'll be back again for our next Tech Talk on November 9th. And the topic will be cyber liability insurance. So please join us again. Thanks.
Great. Thanks, Nancy. Thank you, Alan.
Thank you.